It's not uncommon for people to make major life decisions by weighing the pros and cons, weighting the odds and the averages, looking at how a decision might turn out and what are the chances that it could be positive or could be negative. However, when it comes to investing, that kind of weighted analysis, weighing the positives and the negatives, looking at the averages, can often be misleading. Some investors only look at the average returns as the primary method that they use on whether or not to invest in a particular stock or bond or index. This investment model, this approach, can often lead to unintended consequences and outcomes that you totally weren't expecting. What are the averages? Well, as the name suggests, it's a way of looking at the total return of an investment and dividing it by the number of periods that return was generated by, and thereby you end up with a number that suggests that the returns would have been generated year by year by year. Now, the purpose of calculating an average is to give yourself a metric that you can use to compare one investment against another. And many investors go no further in this process. They only look at the average return and use that to compare one investment against another one, and that becomes the basis of their choice. The thinking is that the past investment performance, the average return, is the primary basis for making an investment decision to achieve a particular financial goal like retirement. Unfortunately, it's not that simple. Average returns are almost like average temperatures. It's only a snapshot of what happens over a course of time, like, for example, a year. If you were to take a look, you would see that San Francisco and St. Louis have about the same average temperature throughout the year, 65 degrees. But if you don't take into account the variability that occurs throughout the year, you're going to be misled in what it's like to live in San Francisco or St. Louis. St. Louis has higher highs and lower lows, where in San Francisco, it's about 65 degrees every day of the year. If you don't take into account those fluctuations, if you don't take into account the variability, you could lead yourself to a decision that may not be exactly what you were hoping for. You wouldn't take into account those temperature fluctuations if you're only looking at the averages. So when investing, you not only want to take a look at the average return, but you also want to take into consideration the average fluctuations. In other words, how high are the highs and how low are the lows? Even more important, how high are the expected highs and how low are the expected lows? What is normal for this particular investment? In other words, what does normal price behavior look like? Let's take, for example, the Standard & Poor's 500 index, which has been around for about 90 years and has returned an average return of right around 10%. But what's interesting is that the Standard & Poor's 500 over the last 90 years has rarely performed at exactly 10% in any given year. It's much more likely to find the S&P 500 up 25% in a given year and minus 5% in any given year. Any range of fluctuation between minus 5 and plus 25 is normal for the Standard & Poor's 500. Think about how that knowledge might affect how patient you would be as an investor in the Standard & Poor's 500. Because if it were down 5% this year, you'd look at that and say, oh, that's normal, that's to be expected. Same as if it were up 25%. You wouldn't get super excited because anything between minus 5 and plus 25 is normal. The lesson is that if you're only basing your decisions on average returns, you could be misled, which would lead to disappointment and the greater possibility of making a poor decision. There is a bigger picture that includes how an investment behaves as well as what it earns. Understanding how average returns and volatility work together is one of the many challenges that investors struggle with in creating their financial plans. Markets are complicated, and the things that you need in order to retire comfortably and stay comfortably retired are many. It's not easy to navigate these complexities and to manage your emotions all by yourself. Good financial planning is an ongoing and dynamic process between you and your financial advisor. And the outcome of that dynamic process is a reduction of overall volatility and risk and a sense of confidence and tracking towards your goals. So when you're putting together your investments, think beyond the averages.